Started. Okay, so all right, so today we're moving on to something more like a real-world application of credit risk. We're going to look at credit default swap markets, and we're going to learn how to price CDS. Okay, so structural models, intensity models. The main point of these two sets of lectures is to understand what is the economics driving credit risk. How do people use models in order to understand credit risk? And today we are looking at credit derivative markets. Okay, so the loose plan for today is we're going to define what credit derivatives are, and we're going to spend the rest of the day really looking at the main, the big player in the market, which is credit default swaps. We're going to learn how to price credit default swaps, and we're going to look at some of the comparisons between what is a CDS and what is a corporate bond yield. So, credit default swaps or credit derivatives is a huge market. So like it really, really boomed in the run-up to the financial crisis, which is why we call it the credit crisis, or why some people call it the credit crisis. And loosely speaking, we can dissect credit derivatives in the following way. We can think about credit default swaps as one particular product and group everything else into related credit derivatives. So within the credit default swaps market, there are two main players, which is the single name credit default swaps and multiple name credit default swaps. Single name credit default swaps are exactly what you think they might be. They're credit default swaps written on single entities. So for example, a credit default swap on IBM, a credit default swap on you name it. And you can also have multiple, so there's also credit default swaps written on multiple products. We're going to be looking at that in the future. So multiple name credit products are becoming increasingly popular, and in fact they're probably the most popular product now. In fact, they're going to show you some evidence soon that the actual single name product has dried up quite a lot, and especially since the financial crisis. So this is going to be like one of our concerns in the following weeks. Today we're really going to focus on the benchmark case, which is what is a vanilla CDS, single name product. So credit derivatives are something which emerged in the 1990s and had a rapid boom growth during the 2000s, right up until the financial crisis. Why were they invented? Or why are they a very useful product? They're a very useful product because they allow the investors to really separate risks cleanly. So unlike, for example, if you look at this plot again, products like a total return swap, which, for example, swaps the total return of any asset for a fixed payment. These products do not give you a clean measure in order to hedge your credit risk because they involve many other risks, for example, interest rate risk or market risk. So credit derivatives became incredibly popular, and they are a valuable tool for managing risk because they separate different types of risk and really allow you to hedge the pure default risk component of or whatever you're investing in, so your portfolio. So it allows you to uncouple, decouple risks. At the same time, they're super popular because it also allows people to speculate. So we're going to see today there is an equivalence between corporate bonds and CDS. The corporate bond market being very illiquid for institutional reasons being that the main players in corporate bond market tend to be mutual funds and life insurance companies. You tend to buy and hold. So the corporate bond market tends to be very liquid for this reason, but we're going to see that there is an equivalence between CDS and corporate bonds, and CDS, much more liquid. So the go-to for the main player in the corporate bond market is CDS. If you want to trade the lending market. Why? If you think about it, okay, the intuition is going to be the following. If I buy a CDS, what am I doing? I'm betting that, well, one of two things. I buy a CDS because I own a bond and I want to insure myself, or I can buy a CDS even if I don't own the bond. If I buy a CDS and I don't own the bond, when do I make money? I make money when the firm defaults. So what am I doing? I'm betting on the bond price devaluing. So when do I make money? I make money when prices go down. So buying a CDS is equivalent, and we're going to see this soon, it's like shorting a bond. Okay? So it allows people not only to hedge risk by buying and insuring my portfolio of risky loans, but it also allows me to speculate because I don't even need to own the bond itself. Yeah, so a few definitions before we get into things. Something which is often confused when people talk about derivatives is the size of the derivatives market. In particular, what is a notional value versus a gross value. I'm going to show you some numbers in a minute which shows you the size of the credit derivatives market. The size is important in terms of understanding size. We really understand what gross versus notional values are. So derivative markets. Derivative markets often allow you to, when you invest in derivative markets, you often invest in derivative markets through a brokerage account when you trade on margin. Or if I invest in, for example, if I invest in a futures contract in the S&P 500, what am I doing? Investing in a futures contract in the S&P 500, for example, today, the S&P 500 big contract now is acclaimed 250 units of the S&P 500. So 1 unit of a futures contract is acclaimed to 250 units of the S&P 500, which means that if the index is trading at 1,000, hypothetically today, and I buy a single contract, my futures contract is worth 1,000 times 250, which is $250,000. Okay, so I have a leveraged position in the futures market with a leverage ratio of 250 to 1. The notional value of this contract would be 250,000. That does not mean there are 250,000 units of the S&P outstanding. It just means the notional exposure that I have is 250,000. Okay, that 250,000 is never exchanged. Why? Because I only ever posted 1,000 initially. Right, so the notional value and the gross value are different concepts. Another example, if you think about an interest rate swap. Interest rate swaps are, a vanilla interest rate swap is usually a fixed for floating interest rate swap, written on some notional amount. So the notional amount may be $100, for example, and the fixed payer might be paying a premium of 5%. I would pay 5% on that $100 twice a year, so I'd make $2.5 payment twice a year, $5 in total, and the floating rate payment might be LIBOR, for example. The notional in this example was $100. That $100 is never exchanged, just like the 250,000 is never exchanged here. The $100 in a hypothetical interest rate swap would never be exchanged. So notional values are not the main determinant of the size of a market. So when I'm going to talk about the size of a market here, we don't really, so notional amount is, the notional amount of a derivative market is loosely connected to size cash flow payments that will be made. What we care about when we think about risk or the total size of a market is actually the gross value. The gross value is defined as the cost it would be to completely replace all contracts. So in this example here, the gross value of this contract is $1,000, not $250,000, for example. Okay? So keep that in mind when I show you this plot. So how big is the credit derivatives market? The answer is massive, astronomical in notional terms. But again, notional terms is not exactly what we really care about. So this is why this is in notional terms. And what I'm showing you is a plot from the BIS, where on the x-axis you have time, so this is 1999, and this is just up to the financial crisis, is 2007. What you're seeing here is the notional amount in trillions of dollars outstanding of the market. The grey line here, the grey bars you see is, you might not be able to see this, but this is the interest rate contracts outstanding. So this is actually interest rate swaps. So this is example number 2. Okay. Example number 2 says there is a huge market for interest rate swaps. Oh, the grey lines tell you there's a huge market for interest rate swaps. So for example, just before the financial crisis, the market for interest rate swaps was close to $400 trillion, notional terms. That sounds like a big number. To put it in context, how big is it? Well, the total expenditure of the US government in 2007 was $3.5 trillion. That's $400 trillion. So it's more than 100 times the expenditure of the United States. The total value of the US stock market in 2007 was 23 trillion. And the total value of gross world domestic product was 65 trillion. So the notional amount standing, the credit derivative or just of the interest rate market before the financial crisis was far exceeds world GDP. The blue line here, okay, you see is non-existent in the 1990s, but starts to become a big chunk of this total notional value in 2007. So after interest rate derivatives, which are by far the largest derivative market in the world, before the financial crisis, CDS was the second largest market in the world in notional terms. Again, what does notional terms really mean? Well, notional terms is not exactly the quantity that we care about, but it gives you a useful measure of risk, nonetheless. So gross values represent the cost of replacing all outstanding contracts. So what I'm showing you here now is, instead of notional values, gross values, okay? So hopefully you can see this in your actual slide, but this again is beginning in 1998, and they're now extending this all the way to 2007. And the red line this time, the red bars, is the interest rate derivatives market. So now we're in gross terms, and this number here goes between 0 and 40 trillion, okay? So the size of the interest rate derivatives market, also the interest rate derivative market, just before the financial crisis was about $20 trillion. So in $20 trillion is still an enormous number. So it's 5 or 6 times the size of US government spending in gross terms, the cost of replacing all outstanding contracts. CDS, on the other hand, is the blue line here. So CDS is the gross value. How large is the CDS market? Well, you see what happens here is it's non-existent here, and it becomes huge here. So that number there is about, well, so I have it here. So the gross value in 2011 of the CDS market was 2.5 trillion. In just before the financial crisis, it was about 5 trillion. So that space there is about $5 trillion. That number there is about $5 trillion. So it was down, it halved from the financial crisis till today, roughly speaking. And I think estimates, recent estimates I've seen say it's sort of has not quite recovered to these levels, but it is growing again. The main point here is that once you take off interest rate derivatives, which are the main hedging tool for institutions, okay, that they're trying to for risk management purposes, the CDS market is the largest derivatives market in the world. So it's hugely well traded. Here I'm showing you the same thing, but I'm showing you a breakdown of multi-name CDS versus single-name CDS. So just to take you back to this plot, we think about credit risk, we can dissect credit risk products into pure credit risk products that separate credit risk and credit risk-related derivatives, which include, for example, total return swaps, which have interest rate risk in them. And within the credit default swaps, pure risk, credit default, credit risky products categories, we have single name products and multi-name products. Within this 5 trillion here, at this point in time, most of the market was in single name instruments, meaning credit derivatives written on single entities. Credit derivatives written on single entities. Since then, there has been basically a decline in all credit derivatives traded. So this is the credit boom, and here's a decline in the credit markets in general. But roughly speaking, today is 50-50. So there's like a 50% split between multi-name products and single-name products. So single-name products still a huge market, but just not quite as important as they used to be. Okay, so let's define a credit CDS. So they were invented in 1994 by this smart guy called Blythe Masters, and they were initially developed by JP Morgan. Some of the most famous industry models, for example, the JP Morgan model, is a model for a very simple model for pricing derivatives or credit derivatives. We're going to look at it later. So, what is a CDS? Well, fundamentally, a CDS is an insurance. It's an insurance which consists of 2 legs: a protection leg and a premium leg. The protection leg is so it's a swap, okay? Typically, the swap payments are exchanged quarterly, in the US at least, and it's an insurance where a protection buyer will exchange a premium at regular intervals for the life of the contract. Typically, contracts are 5 years. The 5-year CDS is the most liquid, and the protection buyer will pay a premium over the life of that contract until maturity, conditional on no default. So the premium goes paid regularly. However, conditional on default, the protection seller has to compensate the protection buyer by replacing the par value of the bond. Okay. So, what does it look like? It looks like something like this. Typically, we think about companies issuing debt. For example, a company might issue a corporate bond that pays 8% a year, plus some par spread. And in exchange, I'm going to buy a corporate bond off company X. I'm going to give them 10 million. They're going to make a payment to me regularly with a coupon 8% per year. This is the full risky bond. So I would want to do something like insure myself against the case of default of this bond. How do I do this? Well, I'm going to go to a bank and I'm going to buy insurance against this bond defaulting. So as the protection buyer, I would pay a premium to the bank. As a protection buyer, I would pay a premium to this bank quarterly, conditional on no default over the life of this bond. So I'll buy a 5-year CDS, I'll make regular quarterly payments until this bond defaulted. If this bond defaults, what happens is, well, the bond defaults, the bond will go into an auction, the bank will pay me par on the bond, and in exchange, they receive the bond. So, what's the risk involved in this? Well, if I think about this credit risky bond and I buy insurance, it becomes a default-free bond. For example, in this example here, what is the risk-free rate? The implied risk-free rate is 8% minus 1%, because that's the worst I can do as an investor. Okay. What about the bank? What's the risk for the bank? The risk for the bank is the bond defaults and they have to pay off. They have to pay me. What's the most the bank can lose? The most the bank can lose is the full face value of the bond. However, that doesn't generally happen, because what generally happens is after a default, there is a settlement process through which we decide how much money to exchange. How much money we exchange is determined by the secondary market price for the bond. The secondary market price for the bond is going to be the post-default price. Typically what will happen is that there will be a default. Default is defined in, there's many types of default or credit events defined. There will be an auction through which the post-default price is worked out in the market, and 100 minus that secondary price will be what's exchanged. Okay? Two types of settlement, physical delivery or cash settlement. Physical delivery is not so popular anymore for reasons which I will explain. And the cash settlement process is what is essentially the most popular way of defining what the recovery value that will be paid to the investor nowadays. So, settlement works like this. Typically, the CDS contract, within the CDS contract, the reference bond is not a single bond. The reference bond will be a company who issues a bond with a bunch of maturities. So when there is a default, there's going to be a delivery option by the protection seller. I buy protection against company X from JP Morgan. If the company defaults, JP Morgan has the option to give me one or has the option to deliver a number of bonds within some spectrum, within some maturity class and some rating category. What this creates is something called like the cheapest option to deliver. So they, the JP Morgan often will, what will happen in this type of example is that if there is a physical settlement process through which they were going to deliver me the bond, or I'm going to deliver the bond, there's going to be a something called a short squeeze, right? So there's a bunch of bonds on outstanding, and I have the option to deliver the cheapest one. I'm going to try to deliver the cheapest one. Since supply is often supply of the corporate bond market is generally smaller than the CDS market in itself, this creates like a huge supply shock. So that's why exactly the CDS traders nowadays have moved from the physical settlement to cash settlement because of these like naked CDS positions, so to speak. So CDS auctions nowadays have moved towards cash settlement precisely because the size of this market is so big. The CDS market is larger than the corporate bond market. Okay, the CDS market itself is larger than corporate bond market. All right. So how is prices actually determined? So prices on default are determined through an auction recovery process. So bond defaults, cash settlement is determined via an auction. An auction is a process through which the post-default price is determined, and it looks a little bit something like this. So this is a timeline of default. Typically, there will be some kind of technical default. Usually, a coupon is not paid, but it could be many other reasons. The company defaults, and between 50 and 60 days afterwards, there's going to be an auction through which a bunch of traders will determine what's the post-default price. And typically, it could, okay, so in the worst case scenario, this could actually last for many years. So I think I'm going to show some evidence on this in a minute. The typical post-default, the auction recovery price process takes about 30 days. With difficult default structures, for example, Lehman, it took years for the post-default price of the Lehman bonds to be determined. So defaults. So I've posted online a really nice paper on this by Helwig and co-authors who looked at the all auction processes, all auctions that had been conducted once cash settlement really started to be the most important determinant of the market. And I'm giving you an example of a table here from one of their, from the appendix here, where they actually they give you a bunch of outcomes of various auctions. So Lehman is in here, okay? So what you see here is that it tells you the timeline here. So the number of days from default, so the default day until the days before the auction, the days of the auction, initial prices of the bond from par value, so from 100, and the final price of the auction. So CDS auctions, this is the initial price of the auction, and the auction price essentially did not change from the initial price to the final price of the auction. So they argue in this paper that essentially auctions are a very efficient way of determining price discovery. If you allow people to trade in auctions, the prices of bonds are very quickly determined by the market. And so it becomes a very efficient way for bonds to retrade. Point here being that, back to this picture, what is the risk? The risk-free rate in this example is 7%. What is the risk to the protection seller, JP Morgan? The risk of protection to JP Morgan is not that they will lose all of the face value of the bond if company X defaults. The risk is that they will lose 100 minus the auction price. Okay? The auction price determined by a secondary market where a bunch of distressed debt traders will trade. Okay? This is why the market for CDS is so big and so important, because it allows people to share risks. It allows unsophisticated investors to meet sophisticated investors, which ultimately allow companies to lend. Okay, so so people often think about the CDS market as being, well, what did Warren Buffett say? Warren Buffett said that the CDS market is weapons of financial mass destruction. Okay, it's a bit too much here, right? Because what the CDS market does is really allows people to share risks, and it allows companies to lend. When companies can lend, they can produce more goods. When companies produce more goods, we can buy more goods, consume more goods, and it's better for everyone. So the CDS market, auction recovery process in general, it's a great tool and very important part of the financial system. So an example here of, so WorldCom is here. Maybe WorldCom's not in this one. An example of a real-world CDS transaction that was conducted. So this is a CDS. So this paper is also in the reading list, and it's a CDS protection which was traded in the early 2000s. So in January 21st, one could have bought 5-year CDS protection against WorldCom, who were trading with a coupon of 7.75% with a 5-year expiry. Okay, so there was a bond which expired on April 1st, 2007. So one could have bought protection in 2002 against this bond, which was trading at 7.75%. The protection buyer of the CDS so imagine the protection buyer owns 10,000 bonds with a face value of 1,000. So when it's trading at par, this would be a £10 million portfolio. On this 2002, you could have bought protection against WorldCom for 169 basis points. So 169 basis points is 1.7%. So 1.7% minus the 7.7 here is a 6% bond. So I could have earned a 6% risk-free return on WorldCom by trading CDS in 2002. Okay? So how would it have actually worked? Well, if you'd have bought this CDS protection, you'd have paid a quarterly payment. So A stands for accrual factor. So it's typically in the US 1 quarter. You'd have paid a quarterly fee. So this would be depending on the days in the quarter. This would be the pro rata payment of 169. So 42.25 basis points per quarter would have been paid in order to own this CDS. What would have happened? I'd have paid those 42 basis points on some notional value. The notional value being, in this example, the 10 million, which would not have been exchanged, okay? It would have just been, it's the notional value, not the gross value. What would happen here is that I would make the payment until what? Until either WorldCom failed to pay a coupon or they went into some sort of restructuring. If no default happened, the protection payer pays this premium until the life of the bond. In this example, it would have been a 5-year, 5 times 4 payments. So 20 payments of 42 basis points. What would trigger a default in this world, or in this example? At what point would WorldCom have defaulted? So most of these examples for default, so the default credit events are, all of them are pretty well, all of them are relatively well defined, except for one, which is restructuring. So typically, missed payment or a missed coupon are default events. So a company cannot service its debt. It cannot service its debt, it decides not to pay, maybe strategically, and its bonds go into secondary auction. CDS gets triggered, and the protection buyers end up with a payment of par for that bond. In this example, 10,000. The difficult part is or the interesting part is actually what happens in the case of restructuring. This is often not so well defined, and it depends on definitions, or it depends largely on the rating category interpretation of whether there was a default or not. So in this example here, so this example I'm giving you here is a real life example, which is Conesco. So Conesco deferred its loan, okay? So they deferred a bunch of loans that they had outstanding. They didn't pay the coupon, but they restructured. So in this example here, what happened was Conesco, they extended the maturity of their debt, and they raised the coupon rate for all outstanding investors at the time. This would be a typical restructuring. So they changed the capital structure of the firm. They reissued debt at longer maturity and a high coupon rate. When Conesco did this in the early 2000s, Moody's deemed that this was Moody's deemed that because of the increased coupon rate paid to the senior tranche investors, that this was not deemed a distressed debt event. So the the investors were compensated already for the restructuring of the debt. ISDA, however, the ISDA definition of a credit event, this came under a default process. So there was in this example, there was two types of there's different types of restructuring, and the restructuring, whether this is a default event or not, depends on the ISDA definition. So there are 3 or 4 definitions now of what classes of a distressed debt restructuring event. In this example, in 1999, this was classed as full restructuring, and it was a credit event. So any restructuring was a credit event in 1999, and this produced a CDS, this triggered CDS in this case. After the Conesco case, because of the fact that Moody's did not deem this a credit event, people started, or the CDS contract started to be modified. For example, now we have a modified restructuring event, which limits the bonds which can be delivered up to a maturity of 30 years, after which case a CDS contract will not be triggered. This has subsequently been modified again, so we now have something called a modified restructuring event, which extends the maturity up to 60 months after the maturity date. And now in the US, companies can restructure and not have there cannot be a credit event triggered at all. So in Europe, we have a very famous example of this, which was a super complicated case, which was Greece. So the Greek default was a restructuring. So at the time, it was unclear whether this would have triggered the CDS or not. In fact, it did trigger the CDS in 2013. So Greek restructuring was one of the famous landmark cases in Europe, which is along these lines. So it's a super complicated process, and it really down to the legal people. What we're going to concentrate today on is the simple case, which is thinking about what happens when a firm defaults by not paying a coupon. This is very clear. All right, so why are they so popular? 2 reasons. Shorting bonds is difficult because the corporate bond market is super illiquid, and we're going to see that shorting CDS is equivalent to shorting corporate bonds is equivalent to buying a CDS. Secondly, it's an easy way for firms to manage risk. So there's 2 sides of the coin: speculation and hedging. Okay, and that's why we see the enormous growth. So let's skip this. Okay, a couple more definitions before we see some equations. Okay, so how does CDS work? CDS works by a premium being paid. This was how it worked until 2009. So there's a huge growth in the CDS market, and there's been a huge growth since 2009 again. So the market dried up and it's rebounded. Part of the reason for this is that CDS has gone through a standardization process. So today we're going to talk about something called the fair premium. The fair premium is the fair value of a CDS that equates the protection buyer's present value of payments to the protection seller's present value of payments at initiation. So like the fair value of a swap, any type of swap, is set at initiation, so the value to either counterparty is equal to 0. Since 2009, however, there's, in the US, and now similarly in Europe, there's so-called the Big Bang. The Big Bang is the name coined for the standardization process of CDS. So CDS are inherently OTC contracts, but now they've gone through a process through which all payments are standardized in the following way. A typical CDS contract now is quoted in standardized units of between 100 and 500 basis points. So you go to JP Morgan, they're going to quote you 100, 200, 300 basis points for insurance against any company. Then what happens is that we determine there's going to be an initial payment which offsets this standardization process. For example, if the premium leg was 50 basis points, the fair premium was 50 basis points, and I was quoted 100 basis points, the premium payer is paying 50 basis points per month or per quarter more than they should. So there will be an initial payment given by the protection seller to the protection buyer in order to offset this payment. The other way around, if the fair premium was larger than the 100 basis points, then the protection buyer will pay the protection seller the difference between the fair payment and the premium payment. Why do they do this? Well, they do this because it's an easy way of, it creates liquidity in the market for the following reason, that with the upfront premium, with a fair premium, imagine the following scenario. I buy a CDS, the initial premium was 50 basis points, and the credit quality of the firm goes down. The credit quality of the firm, okay, so maybe I should pick the numbers here. So imagine that the fair running premium was, I bought a CDS contract with, well, the premium was 100 basis points. The 100 basis points would be paid for the life of the bond every single quarter, or for the life of the CDS. And then imagine in the future, what happens is the credit quality of the firm goes down. When the credit quality of the firm goes down and I bought a CDS, that means the premium is going to go up. It means I'm going to make a profit. How could I lock in that profit? Well, I would want to reverse it by selling the CDS. What matters is the premium leg in the valuation of the CDS. So what would happen here is that I would sell the bond, I would buy the bond for 100 basis points, I would pay an initial 100 basis points, and then I would sell a future 120 basis points, meaning that I was collecting 20 basis points for the life of the bond. How much is that 20 basis points worth to me? That 20 basis points is worth to me today. Well, that depends on a model for credit risk. Okay? So it's difficult to value the returns to CDS if you have this upfront payment fee. However, with a fair payment fee, it requires a model in order to value it. With a standardized premium, things are much simpler. If I was paying an initial 100 basis points, I've exchanged an upfront payment in order to make the contract fair. In the future, if I sell, I'm simply going to sell at the 100 basis points as well, and I'm going to re-exchange the fair premium between the upfront premium and the fair difference. So with this standardization process through which we always trade at an upfront cost, it makes it much easier for people to buy and sell, and therefore facilitates liquidity of the market. Okay, having said that, what we're going to do is actually value things the old-fashioned way, because once I can value the fair premium, valuing the upfront premium is simple. I simply just, if I know that the fair premium is 50 basis points and the standardized premium is 100 basis points, then the upfront difference is just a lump sum payment at the start of the contract. So we're going to just run through some arbitrage arguments here, which shows you that in order to value this CDS premium. And the basic idea is going to be the following. Well, it's basically everything we do today is going to come back to this picture, which is that if I buy a risky bond at 8% and I insure it with a payment of 1%, the difference is 7% risk-free. So what's the premium that I would pay in this example? Well, you can reverse the argument. If I know that the risk-free rate is trading, if I know the risk-free rate is trading at 7% today, and I know a corporate risky bond was trading at 8%, then the premium must be 1%. Okay? In other words, by no arbitrage, if I buy a defaultable bond and I insure that bond, it must be equal to a default-free bond. Therefore, if I know what the default-free bond rate is, and I know what the defaultable bond rate is, I know what the credit default swap spread should be. Okay, so this is essentially going to be the argument that I can replicate the cash flows of a CDS by trading default-free bonds and risky bonds. So, okay, so let's take a 5-minute break before we go through this, and then so there's going to be two parts to this. I'm going to describe exactly how cash flows, how one can replicate a CDS by trading these two things, and then there's going to be some algebra. Yeah, so basically how it works is that there is going to be some company or some investor who, this could be a mutual fund, for example. They buy a risky bond. The company, I give them initial money for the bond, and then the company is going to pay me a coupon for the life of the bond. And then at the end of the bond, they're going to pay me back the face value of the bond, assuming that they don't default. The third party here is a bank. So once I own the bond, I'm receiving risky coupon payments. Risky coupon payments may or may not be paid. I mean, the way I recover the coupon rate, the par value of the bond, the yield to maturity of the bond is I only receive that if all of the coupon payments are made. So I go to a bank and I buy an insurance against this bond. So as I receive 8% coupon a month, and I pay them a fee. The fee in this example being 100 basis points.
But isn't that the transactions between this bond? Oh, sorry, this is.
This is a company. This is another company. This is a bank.
Oh, you mean this? The transaction between them is the CDS.
Yes, exactly. This is the CDS
bond
transaction, and this is just the corporate bond market.
Okay, this is
So
like
this is
underlying.
Yes, so this is the corporate bond. Yes, exactly. This is the underlying corporate bond or the reference entity.
Yeah.
This is the insurance market for that bond.
Oh, I see. Yeah, I misunderstood that. This was like the CDS contract.
No, the CDS is this part here.
Okay.
Yeah.
Thank you.
Okay, so it's simply a way of standardizing the contracts and make them more liquid. But basically what happens is that if there is a fair premium of, say, a model tells you that the fair premium is 50 basis points. That will be paid, and let's say that's paid quarterly for the life of the payment. Let's call that the fair premium. The standardized premium would be 100 basis points. So the fair cost of the insurance was 50 basis points, but the standardized premium says it's 100 basis points. It would always be 100 basis points today and tomorrow. The difference being 50 basis points. So I'm paying 50 basis points too much. The upfront difference would be, I would pay, it was a 5-year bond, it would be 5 times 4 payments times the difference, which would be 50 basis points. So if in this case, if I bought the CDS, I would actually gain this amount of money at the start of the contract, and then I would pay that 100 basis points for the life of the contract. I'll explain it again, but yeah.
Okay, but like pricing it, how would you price it?
So we are gonna learn how to do this, and then this is just like the standardized way of doing it.
Because essentially like you're paying this back, but then there's also like the time value of money you pay.
Yes, this also is going to be the discounted value of this, right? But we can work out that discount rate from the interest rate market. Why is this done like this? It's done like this because when I resell it, what happens is I just exchange back the fair payment. Right, so it doesn't require me to revalue the debt in the next period. Okay. Let's make a couple of things clear here. What am I trying to explain to you at the moment? I'm trying to explain to you the equivalence between CDS and the corporate bond market. So just to go back to this picture, you can think about this in two ways. You can slice it this way or this way. This way is the corporate bond market. This is the market for borrowing and lending between investors and corporations. This is the CDS market. The CDS market and the corporate bond market are linked by no arbitrage, but they can trade independently. What will happen in what is a CDS contract? A CDS contract is an regular exchange of a premium, let's call it a fair premium, in exchange for an insurance conditional on default. What would happen in default in this example? Imagine the face value of the bond was 100 and the bond defaulted. The compensation paid by the protection seller, the bank, to the protection buyer, the institution or the investor, is typically the difference between the face value of the bond and the ex-post defaulted price of that bond, which is determined by an auction. So imagine in this example, company X defaults at some point in the future. There's going to be an auction where that bond is then going to trade in a secondary market. Let's imagine that the ex-post price of the bond was 5 million. What would happen here is the bank would pay the investor the difference between 10 million and 5 million. Okay? So they compensate them for the loss of the value of the bond. Who still owns the bond? The bond is sold at the price with the ex-post auction price by the company. Okay? So the most you can lose most you can gain is 100, or the face value minus the ex-post default price. The most the bank can lose is symmetrically the same. What do I mean by the fair premium versus the upfront premium? So I'm going to show you the equivalence between corporate buying, I'm going to show the equivalence between selling CDS and shorting bonds shortly, and then we're going to work out what the fair value of the CDS is. I talked about this thing called standardization, which was something which happened after the Big Bang. The Big Bang was a way of standardizing contracts in order to facilitate liquidity in the market, and essentially what it says is that there is now a upfront premium which all contracts are written against. It's typically somewhere between 150 basis points in 100 basis point increments. What do I mean here? And in a moment, we're going to work out something called what is the fair value of a CDS. Let's imagine that fair value was 50 basis points. How do I determine that 50 basis points? Well, a bank is going to quote me that number. They're going to have a model for it. Now, the standardized contract, let's say a standardized contract was for a particular company was 100 basis points. How does the CDS transaction work? The difference between these two is 50 basis points. So the 50 basis points, there's a 50 basis point difference, which would be paid quarterly over the life of the bond. Let's say the life of the bond is 5 years. So, well, that's paid quarterly, just to make clear that that's a quarterly payment. If it's a 5-year bond, there will be 5 of these 50 basis point payments, 20 of these 50 over 4 basis point payments, discounted by, if you discount all of those payments by the risk-free rate, let's imagine the risk-free rate is constant, the difference is going to be paid in this case, the fair payment, the standardized payment was more than the fair payment. So this present value of the difference would be paid by the seller of the contract to the buyer of the contract. The other way around, if the fair payment was larger than the standardized contract, I would give you some money to compensate you for the difference between the fair payment and the upfront payment. Ultimately, what we care about is the fair payment or the premium leg payment. Okay, that's what the valuation. That's what we care about when we value things. So that's what we're going to work out after. After initiation of the bond, at initiation of the bond, there is a different concept. So let's imagine that we want to price a CDS at date T, date 0. So imagine there is so B stands for buyer. Imagine we're trading a CDS which calls for the delivery or payment, well, this should be delivery by B to A, of a defaultable bond. Okay, so B is the buyer of CDS, and let's imagine that that CDS is written against a defaultable floating rate note. What's a floating rate note? A floating rate note is a note that pays some spread above the risk-free interest rate in every period. Let's imagine that that spread, let's call that spread S. Let's call that, so the floating rate note has an interest rate of S above the risk-free rate R. So simple arbitrage argument is going to show you that we can replicate the cash flows of this CDS with the following portfolio. By selling the floating rate note and buying the default-free note. What will the cash flows of the CDS look like? If I buy a CDS I'm going to pay a spread on it every single period until default. On default, I'm going to deliver you the bond. I'm going to receive 100, the face value of the bond. Okay? Now, think about the cash flows of this. Imagine I sell a defaultable rate note. I take that 100 and I buy the default-free note. So everything's trading at par. I hold these positions until a credit event, and then I liquidate the portfolio. What do the cash flows look like? I sold a defaultable rate note. It was paying an interest rate R every period, which was time varying, because short-term interest rates can time vary, plus a constant spread. These are the coupon payments of a defaultable rate note. At maturity, I get back the face value of the bond. So these are the payments going out. Okay, I'm short these payments, but I took that $100, which I initially shorted, and I invested it in a risk-free bond. The risk-free bond just pays the risk-free interest rate. Now, it's clear that if you look at this payment, these cash flows, it's obvious that I'm simply every single period, because the net at maturity, the face values net out, at every single period, I'm just paying the spread between the risk-free rate and the floating rate note coupon, i.e., I'm paying the yellow bars, which is the spread. Okay, so what happens here is I pay the spread every period until maturity of the bond, or if there's a credit event, restructuring, or the company fails to pay its coupon, what is going to be the cash flow? The cash flow is, well, I get to deliver you the bond, P, and you're going to give me 100. The P, where's the P determined? The P determined by an auction, and 100 is just the face value of the bond written into the CDS contract. So this has exactly the same cash flow profile as buying a CDS. Okay? So the cash flow profile here is the cash flow profile of a CDS. So what is a CDS? A CDS is equivalent to selling a bond and investing it in the risk-free rate. Which makes it clear that if I buy a CDS, it's exactly like shorting a bond and investing in the risk-free rate. The other way around, if I sell a CDS, it's like taking a leveraged position in the corporate bond market. If I flip this around, selling a CDS is like selling a default-free bond and investing in a corporate bond. So selling CDS is like taking a risky position in a bond. So what happens then after there is so at initiation, this must be true by no arbitrage. In an arbitrage-free, frictionless world, the fair premium on a CDS, the S, must be equal to the difference between the corporate bond yield which the CDS is written on and what is the default-free bond yield. Okay? After initiation, what is going to be the price of the CDS? Well, it's we're going to need a model in order to value it, but we can have a look, but we know what direction things are going to go in. So imagine that the credit status of the underlying company went down. If the credit status of the underlying company went down, they're going to, the new investors in the market are going to demand high yields from them. If they demand high yields from them, the price of the bond must have also gone down. So if I buy a CDS on a company and the credit status of the company goes down because they get downgraded, for example, then I make money because I'm short a bond whose price just went down. Okay? So the other way around is that if the credit status of the company gets better, they get upgraded, the price of the bond will go up because I was short, I lost money. Well, it makes it clear that buying a CDS is like taking a speculative position on the state of the health of the company or the credit status of a company. I never needed to trade the bond in the first place. So this would be like the equivalence between, this is like what people talk about when they talk about naked CDS positions. Why do people trade CDS and not bonds? CDS are easy to trade because they're much more liquid than the corporate bond market, and the cash flows are equivalent. So buying a CDS, buying protection against a company, you make money when the credit status goes down. I make an open profit when, for example, there are downgrades, and I lose money when there are upgrades. So buying a CDS is exactly like shorting a bond. So which is why, okay, so up until now in the course we've talked about credit risk, we've talked about structural models. What is the value of corporate bond? What determines the corporate bond, the yields on corporate lending? And we looked at the credit default swap term structure. And I argued that sometimes it's upward sloping, sometimes it's downward sloping, but I never made the equivalent statement. I never said why sometimes we talk about CDS and sometimes we talk about corporate bonds. Yields, this is exactly the reason, okay? Because they are, or they should be by no arbitrage, exactly the same thing. With a caveat, I'll come back and show you that later that they're not exactly the same thing because we do not live in a world without frictions. So, it's basically clear that like a CDS is equivalent to a spread on a floater. A floating rate bond being this, and this being the spread on that bond, okay? How to calculate the CDS, how to calculate a CDS value now after initiation. Okay, so in general, it's super complicated, and there's many, many different models, okay? And it's one of those things in finance, how do you determine the price of a CDS? Well, if I want to determine the price of CDS, I'm doing this because I'm a bank. So there's investors out there and there's banks out there. Banks will have models for CDS. There will be many models, and in an efficient market, if I'm an investor, I'll shop around for the model, the best price. Okay, so what determines the price is the market. How does the market determine a price? It has a model. Then there's some sort of weird thing that happens in finance by you can back out the model from the market. Okay, so it's the chicken and the egg scenario. But what we're going to do here is work out a no arbitrage argument for how one would value this if you were in a bank. Let's imagine that we are thinking about a T-year CDS contract, and there is a series of M payment dates. So we're going to have, if there's quarterly payments, the time between payments is 1 quarter, there's going to be 40 payments, okay? So 5-year payment, if there is a 5-year CDS, which is typically the most liquid contract, 20 quarterly payments. So what we want to try and work out is what the annual premium C is, which depends on time to maturity, which is paid quarterly. This premium is going to be paid quarterly until maturity or default. Assume the notional value is equal to 1. And let's assume that if there is a default between payment dates, that there is no accrual. Okay, so what does accrual mean is that I pay a coupon every single quarter, but what happens if there's a default within the quarter? What happens to that coupon payment? Well, that coupon payment still needs to be paid, but it's paid pro rata. Okay, so if the default happens 1 month into the quarter, then I'm going to pay 1/3 of that quarterly payment until maturity. But we're going to ignore that for the time being. Just imagine that default always happens on a coupon payment date, for simplicity. How do we value it? So there's 2 things in a swap. You basically want to value what is the value to the buyer of the swap, what is the value to the seller of the swap. At initiation, we equate those 2 values such that so that the present value of the 2 payments is equal at initiation. So first, let's think about what is the value of the CDS to the buyer. So what is the buyer going to get? Well, the buyer is going to get the expected everything here is under the risk neutral measure, the pricing measure. There is going to be a series of quarterly payments for M periods, conditional on default. So this is an indicator function which takes a 1 if default is beyond a payment date TI and 0 otherwise. Okay, so basically what happens is if default happens, this goes to a 0 and the expectation sets to 0. So this is the expectation of 1 times the coupon value which is paid at each payment date TI. And how do we price things? Under the risk neutral measure, we compute expectations and we discount by the risk-free rate. So this is the interest rate which is prevailing between each of these periods. The LIBOR, typically LIBOR, okay? How do we value this? Well, it's similar to how we value things in an intensity framework. What we care about is the probabilities of default. So we think about valuing this thing within an intensity framework where the hazard rate or the instantaneous probability default intensity is equal to lambda. Okay, so same notation as last week. So the expected value of this 1 from the same arguments as last week is just the exponential of this. So this is the survival probability S. Okay. In general, this is a super complicated thing, but we can simplify this valuation by assuming that there is independence between default intensities and interest rates. Otherwise, there's going to be a correlation term here. But for simplicity, assume there is no correlation between the 2, and we can split up this expectation. So going from 1 to 2, I'm just inserting the definition of what the expected value of the default process is. 2 to 3, assume independence between interest rates and the default process, and simply bring out the coupon payment, which is a constant paid every period. You take a look at this, you'll quickly realize that this is equal to the product of a discount rate or a discount factor which is given by the default free term structure and the survival probability. The survival probability can be computed in various ways. So for example, if this was a doubly stochastic process, so if this was a CIR process for lambda, we would have a closed form solution for what this is. But we're not going to do that. We're going to actually do something. We're going to work a simplified relationship out. We're going to take this one step further. So this is going to be the value of the buying leg, the discounted value of the survival probabilities summed over all payment dates. Okay. So this is the risk neutral probability of the reference. So this S0T is the risk neutral probability of the firm surviving between S and T, and this is the discount rate between 0 and T. Protection leg. What happens to the protection leg? So the protection leg is The value of the protection leg is that I receive an amount 1 minus delta recovery rate at default. So the seller of the swap, the value to them is that it's going to be equal to, it's going to be the discounted value of of an indicator function which takes a 1 if and only if default is less than the maturity of the bond. Otherwise, it's a 0. So this is just the expectation of 1 conditional on default. Conditional on default, the notional value of the bond we just assumed was 1. So they just need to compute the value for the seller is just the discounted value of this 1 minus the recovery rate, conditional on default. Okay? So, again, how do we compute the expected present value of that? Well, under the risk-neutral measure, it's just going to be the discounted value of this product. Again, how do we do this? So, all right, so the only trick here in going from 5 to 6 is the following. What is this lambda? Lambda t, sorry. Lambda t, let's call this lambda t. So what's the probability of default in the next instant? The way to think about this. What's the probability that I default at t? The probability that I default at t is the probability that if I was in a binomial world, what's the probability that I default here? So if this is no default, this would be lambda, let's say this is something like lambda 1 minus lambda, or that's p 1 minus p. So there's a probability of default p and a probability of no default 1 minus p. The probability of default in this period here, the probability of defaulting in period 2 is the probability that I don't default, is the probability that I don't default in the first period multiplied by, sorry, the probability that I don't default in the first period multiplied by the probability that I do default in the second period. In continuous time, this is exactly what this is. So remember this S here, the survival between 0 and ti is equal to this function here, okay? It's equal to the expected value of e to the minus between 0 and ti lambda t. This is the probability of survival up until ti. That's like my P1 in this binomial example, right? So the probability of survival in the first period, and then I care about what is the probability of default in the next instant. The probability of default in the next instant is equal to this lambda. So that's where this product comes from, okay? So it's the conditional probability of survival multiplied by the instantaneous probability of default. And then the cool trick here is that, again, if I assume independence between the interest rate process and the default intensity, what is this? Well, this is simply, you can rewrite this as the derivative of the exponential, okay? So you take the derivative of this exponential is equivalent to lambda t e to the lambda. Yeah. No, because this is integrate. So this is a 1. This is it a lambda t or a lambda tau? From the perspective of at t. at tau, yeah. And then that wouldn't make sense here because this is derivative of lambda t dt. Yeah, right, so this is a lambda, but this is not the lambda tau because the conditional probability is and t. This is the expectation of the t. Yeah, so actually it shouldn't be, this should be a, that should be a t, not a tau. Yeah. But this should be a t, right? So it's the condition, what's the survival probability up until t? The survival probability up until t is the exponential minus of the integral between 0 and t. Okay? And then what's the probability of default instantaneously at t? Is lambda t this exponential. Right? So just in notational terms, the probability of default in, so the probability of default at t is the probability that I survive up until t times the probability that I default in t. So that S, that should be between a 0 and a t. Okay? And then the trick is simply that I want to rewrite this thing as the derivative of the exponential with respect to t. If I know the derivative with respect to t, what is this expectation? This again is just a discount rate. There should also be a 1 minus delta here outside the recovery rate. This is just the survival probability times the hazard rate. The hazard rate being just the differential of this thing here. Okay, so here's here is the definition of, so this is correct here. So this is 0 and t. Okay, so this thing here, technically, this lambda hat and this lambda hat are not the same thing. They're related, but they're not the same thing. This lambda hat here is something that we could, it's the solution, it's the lambda hat which computes this expectation, okay? So in an exponentially affine world, we know that we can compute this in closed form. So this is where recovery models come in, okay? So a recovery, a CIR type intensity model is a model for this expectation. We saw that last week. So in general, we can compute the closed form solution to this, but we're actually not going to need to do that because we're going to work it out from the market.
Can you repeat again what's the difference between the lambda
With and without the hat. So a little bit like, so remember I started off with this thing, how to compute something like e to the x would be, imagine x was normally distributed. If x is normally distributed, what is the expectation? What is this? Is e to the mu plus a half sigma squared, where mu is the mean and sigma is the variance of the process, right? This x is clearly not the same thing as this mu plus x. The equivalent statement is that the expected value of e to the integral lambda ds is going to be a function that's going to look something like the integral of if lambda is going to look something like the integral of another function. It's going to be a function of the lambda. Okay? So in general, this is going to be a complicated thing. They're not the same thing, but we can compute them in closed form. Right? Another example of this, what did I talk last week? That we love exponentials because they're easy to compute stuff. What did we do when we computed the price of a bond? If that's the risk-neutral measure, the price of a risk-free bond, the price of a risk-free bond is just equal to minus the integral of the short rate, like the average short rate over maturity, the exponential of minus e to the minus rt. In the Vazicek world, what was the solution to this? In the Vazicek world, the solution to this was the exponential of a plus b rt, where a and b were functions. So now if I just change that to a lambda, I can change that to a lambda. That's just the statement that the expectation has disappeared, but I rewrite this as some integral of some lambda process. And in general, it's complicated, which is why I don't write down the solution to the process. And we don't need to, actually. So this will exist, and we're going to back it out from market prices. It's going to be the hazard rate. It's going to be called the hazard rate or the default intensity, related to the default intensity. All right, so quick summary again. The steps here were motivated by the last week's work on intensity framework. The buyer is going to pay. So what is the cash flows for the buyer from the buyer's perspective? They're going to pay a coupon for the life of the bond, conditional on no default. Conditional on default, cash flows go to 0. Tau, so default indicated by a tau greater than the payment date ti, so we just discount all of these coupon payments by the risk-free rate. Simplifying assumption, we assume independence between the default intensity process and the interest rate, which allows us to split up this expectation. We bring out the coupon rate, so turns out that the buyer's discounted payments, are just the discounted value of the future survival probabilities multiplied by C, the CDS spread. C is what we want to determine. Okay, so the aim of the game is to try and work out what C is. All right. From the seller's perspective, what does the seller do? Well, we're trying to think about a world where the notional value is equal to 1. So the seller receives the coupon payment until default, at which point they pay 1 minus the recovery rate. So what's the present value of 1 minus the recovery rate? Well, it's just the expected discounted value of this indicator function which signals default before maturity of the bond. And so, I tried to make this analogy here between what's the probability of defaulting in some instant in the future t, which the probability I survive until t, and then I default. The probability I survive until t is the integral of e until 0 and t, that was a typo there, multiplied by the instantaneous default at t. Again, assuming independence between interest rates and the default process allows me to separate these expectations. And then the final trick is that what is this lambda t e to the lambda, which is the partial derivative of the exponential with respect to t, times a minus, right, because of this. But this thing here, I can compute in closed form. This thing I can compute in closed form in general if I have a model, okay? So we don't need to know this solution, but you just need to know that this lambda hat is not the same as that lambda. It's going to be related in a way that is analogous to the short rate being related to an exponentially fine, the expectation of the future short rate, or the expectation of the integrated future short rate being related to the current short rate. All right, so how do we value the swap? We value the swap by setting the buyer present values equal to the seller present values, the same as we value any swap, and then we solve for the coupon. Okay, so the value of the fair value of the swap is just equal to this function here, which is the ratio of the present value of the future cash flows from the seller's perspective to the buyer's perspective. The quarter coming in because we have quarterly payments. There was a 1 minus the recovery rate here. There should have been a 1 minus the recovery rate here as well, okay? So this would be, you can think about this as being a zero recovery bond. Okay. So, in general, there's two issues with this. So this is a general formula. There's two issues. Firstly, we've ignored the fact that default might happen within 2 payment dates. So there's an issue of an accrual, which may happen. We're going to deal with that in a second. Apart from that, this can be solved in closed form if we have a model for lambda. For example, a CIR process. However, we're going to sidestep these 2 issues. The fact that this actually turns out to be somewhat complicated, and secondly, there's an issue that we're missing an accrual payment. We're going to sidestep this with an approximation which is used in practice, and it's called, it's called the JP Morgan model. JP Morgan being the biggest, or were at least the biggest sellers of the CDS market. All right, so let's take another break, and maybe you want to ask me some questions or something, and then we're going to finish off how to value this thing. Actually, what I want to do.
The second bracket one, because that's the I don't get from that second bracket to the lambda head.
Yes, this is the this here is the definition of this. So if I take the derivative of this function, take the derivative of this function. So the derivative of this function with respect to t, the derivative of ds0 with respect to t, is what is that? It's the derivative of this expectation with respect to t.
So you take
But we know the closed form expression for the expectation. In general, we can compute it.
Yeah, so you take the expectation from outside to inside the derivative.
Yeah, so swap the expectation and the derivative, yeah.
And then from there...
So for example, I guess the step here is that I want to compute the expected value of the derivative minus of this thing. Zero t lambda s ds. But that's the same as the derivative of, I just take the expectation outside. Minus. The derivative of this is minus lambda, so there's a minus lambda s times this stuff.
And then from the 5 to 6, when is the 1?
That is this. One is the expected, so it's a 1 if default is less than maturity.
Yeah, but then in the second line you write the tau t, not like lambda t, not lambda tau.
Yeah, but t can be, so this is, what's the probability? It's the expected value of this 1. The expected value of this 1 is the expected value that this 1 occurs over the life of the bond, over all maturity. So that expected value of that 1 is the expected value of this product here, integrated between 0 and t over the entire life of the bond.
So there should be an like an integral of the t because t is from 0 to tau. Right?
T is from 0 to tau. Yes.
There should be an integral for that there. Because if not, it's just an instant. So there should be like an integral of t to 0 at line 6, line 5.
This is no, this is fine, right? No, this is just T, right? Because what we care about is this.
This one I don't understand is line H. Suddenly there's an integral
Between 0 and T, yeah.
Yeah.
Yeah, because this is this S here. 0 and T. Actually, so what it should have been is this should have been that is not a tau there. There's a capital T.
Yeah, there should be capital T.
Yeah.
What about this one? This one?
That also should be a capital T.
Yeah.
So we're integrating over the life of the bond, capital over the maturity of the bond T.
Yeah.
What's the expected value of that 1 over the life of the bond? It's at each instant is the expected value of T times the cumulative expected default value, yeah. And then that's why that term here is between 0 and T2, that term there is between 0 and T there too. And then just the expectation is that we're computing that over, then it's just, you merge the expectations. It's the product of two terms on the one integral. All right, so let's finish this part off. So, in general, this is general valuation formula, where we set the buyer leg equal to the seller leg and solve for the coupon, which equates to 2. That's going to be the fair value of the swap. In general, this is a complicated thing to solve for because of two things. Firstly, we need a model for lambda, and secondly, there's an integral up here, which now integrals are not easy to solve. So, second issue with this formula is that, okay, so it has a closed form solution in certain models, but is kind of messy. It ignores the fact that we are missing make the assumption that that default only happens on specific payment dates. So in practice, what's used is a simplifying assumption, which is going to accommodate two things. Firstly, it's going to get rid of or save us the integral, and secondly, it's going to accommodate the accrued premium. So this is the common assumption which is made in the data, or which is made in the market, is that the default that happens between two premium dates happens in the middle of the quarter. So we're just going to make the assumption that between two payment dates, if there is a default, it happens in the middle of the quarter, i.e. it happens at the average between the two payment dates. Okay, this is going to be a very mild assumption because we have quarterly data, right? So with quarterly payments, it's a relatively mild assumption. So with this assumption, in practice, what would happen is that the coupon payment would if there was default between two payment dates, the protection buyer would still owe the protection seller a payment which would accrue with the time horizon between dates. Okay? However, if we make the assumption that the default always happens in the middle of between the two dates, this accrual factor will be equal to a half. Okay, so if this accrual factor was a half, then the payment date will always be a half. The accrual factor will be a half. So I'm going to owe half the coupon conditional on default. So if default happens within the interval, I'm going to owe half the coupon payment to the buyer, who's then going to give me, who's then going to return me, or I'm going to deliver the bond to them. I'm going to receive 1 minus the recovery rate at the next payment date. Okay? If we make this assumption, we can simplify our lives a little bit here, because then if we take a look at the formula again, what happens is the buyer's leg, again, is just equal to the discounted value of all of these coupon payments which happen at payment dates between 1 and M, conditional on default being past these payment dates. And then I'm going to owe one more payment, conditional on default, being between the payment dates. And because of this assumption here that the default happens in between the payment dates, how much am I going to owe? I'm going to owe 1/4 the quarterly coupon payment times a half, because now I just owe half of it. Okay? Where is that going to be discounted back to? Well, the discount rate is going to be between 0 and the midpoint of the interval. Okay, so this will be the buyer's. So under the midpoint assumption rule, these are going to be the expected value of the payments I make. What is this expected value? Well, this expected value here is just the survival probability at tau. So this is the Q. Q standing for survival, or this is the equivalent of S. This is our S to the E to the lambda. And this final one. So what's the probability? So this is the probability of survival beyond T. So it's just the expected value that this is always equal to a 1. What's the expected value of default in an instant, in an interval? The expected value of default in an interval assuming that that interval is, assuming that the default happens, so assuming the default happens within that interval, but the payment is made in arrears from the midpoint to the end of the interval, is the following. This is the probability of surviving beyond t. This is the probability of surviving beyond t minus 1. What's the probability of defaulting within the interval t I minus 1 and t? Well, it's just the difference between these two conditional cumulative probabilities. Okay, so this is just the cumulative, this is just the probability that I default in the interval ti and t. So this is going to be the expected value of the seller's payment leg, okay? Where this is just the midpoint rule, okay? So Q is the risk-neutral probability of survival beyond t. Again, we could split up this expectation because of the independence between interest rates and default probabilities assumption. In the same way, what is going to be the protection, what is going to be the expected cash flows from the seller's protection leg? Well, we assume default happens, if we assume default happens in the middle of the interval, it's just the probability that default happens in an interval discounted by the risk-free interest rate, and how much are we going to pay? 1 minus the recovery rate. Okay, so these formulas are exactly equivalent to what we just did here. We're just using an assumption that default always happens at the middle of the interval. Now, with these assumptions, you can see that, with these assumptions, how do we now value the CDS? We do it in exactly the same way. We set the seller's present value of payments equal to the buyer's present value of payments. Okay? If I take a look at these two formulas, now I can see that they actually now only depend on two key quantities. So, the two key quantities are the following. There is going to be, if you take a look at this formula, the Q's are recursive. Okay? The Q's are recursive in the sense that the very first payment is discounted by the very first element of this sum depends on two quantities. The very first element of this sum, I equals 1, depends on the Q, which is the survival probability beyond the first payment date, and the survival probability beyond the initial payment date and the TI. If you take a look at the seller's perspective, the same is true. There are two quantities which you need to compute at each point in time for this summation. They only depend on a QI and a QT. So a QTI and a QTI minus 1. In other words, imagine that I told you what the, imagine that we observe the credit default swap spread in the data. So imagine that I know what that is, the CT. I know what that is because it's traded in the market. What we would like to do is try to back out what the lambdas are, what the Qs are. And this is bootstrapping. So in the market, CDS is traded, and we want to try to infer from the market what are the risk-neutral default probabilities. Imagine then I told you, we had a bunch of CDS quotes, and I told you what the very first Q is, the very first default probability. We know what the very first default probability is going to be because it's simply, if I know what the spread is, it's an analytical function of this sum. It's just simply in the, just imagine we have the very first, so I have a CDS quote in the market for 1 quarter. So let's call it C of 0.25. If I know what C of 0.25 is, I know that this C of 0.25 is the C that solves this sum. Okay? The very first sum is just one coupon payment. One coupon payment is so this is the P 0.25 times Q T greater the survival beyond 0.25 if I look at this formula here, the two quantities that I care about in the very first sum is the 1 minus the recovery rate, the P 0, 0.25. Well, so let's imagine we have quotes for 0.25 and 0.5. So we have, remember the coupon, the CDS spread is maturity dependent. So imagine now we had two coupon payments, two CDS spreads traded in the market. The very first payment is going to depend on, this C will depend on the 0.25 plus 0.50 divided by 2 times Q of 0.25 minus Q of 0.50. What is going to be the coupon payment, the C in this example? So this is multiplied by a C over, this is the C. This is multiplied by a C of 0.25. The very first C, 0.25, is a function of the first default survival probability and this spread between the survival probabilities. Imagine you knew what the first Q is, the 0.25. You could then solve for the second one, the Q equals 0.50. I'll try and make it clearer. In the market, we're going to have a bunch of CDS traded for various maturities, all the way up to 5 years. Okay? Who determines these? The market determines these because a bunch of people are trading them. Now, what we want to try, the aim of the game in CDS is to try and work out default probabilities. Or one of the things about credit is we really want to know what the default probabilities are. That's the holy grail. So imagine you have a C traded in the market, which is just the 1/4 CDS on a company. How do we value that 1/4 CDS? The 1/4 CDS is just going to be the 1/4 CDS premium multiplied by, in this case, there's just one payment, right? Because it's a 1/4 CDS. There's only going to be one payment. So it's going to be the discounted value of this. P, Q, that we survive, that the default probability is beyond the first quarter, right? Okay? So this would be the expected value of this payment plus the probability that default happens in between now and tomorrow. Well, this is 0 for the first coupon payment. Now, if I have a look at what is that coupon, that's 0 for the very first coupon, what is that C? How do we determine that? We determine that C such that the buyer and the seller leg are equal to each other. So this is going to be the 1 minus. There's only one sum. It's just one coupon payment in this example. P of 0. And then we use, because of the midpoint rule, let's imagine that they're traded every quarter. It's going to be 0.25 plus 0.5 divided by 2 times these two Qs. So the Q, which is the tau is beyond 0.25 minus the Q that default is beyond 0.50. Okay, so now if I take a look at this, if I knew what the first Q is, and I know what this C is because it's traded in the market, I can rewrite this and solve for the second Q, the next default probability. Right? So this is, you can just rewrite this and solve for the second Q. Now imagine that we're trying to do the same process, but for the second term in the sum. What's the second term in that sum going to depend on? Well, it's going to depend on the first Q, the 0.25, the second Q, the 0.5, and a third Q, the next maturity, a 0.75, if they were traded quarterly. But if I knew what the first one is, I can solve for the second one. I can iterate this process, and you can see here that at each point in time, that the spreads or the summation only depend on one new thing which I don't know. So I can iteratively solve for what these Qs are. That's called CDS bootstrapping. Okay? CDS bootstrapping is that I read the curve and I simply recursively solve for what these Qs are. The issue here is that what is the Q? How do then, once I have a Q, how do I back out what the default intensity is? So there's one more assumption here is I can back out all of these Qs, and then I make the final assumption that in between payment days, the default intensity is constant. So we make one more assumption that there is a parametric assumption that every Q is just equal to e to the minus lambda t. So if t is quarterly, and I can back out all the Qs by doing this recursive thing, then I can back out what all of the default probabilities are, lambda. Okay? So that's a bootstrapping. That's called the bootstrap, CDS bootstrap. This is called the CDS bootstrap under the midpoint rule. And that's something that we're going to, so I'm going to ask you in your next coursework, that's going to be part of your coursework, I'm going to ask you to go away and download your favorite company from Bloomberg and work out what the default probabilities of those companies between today and 5 years is. Okay? Okay, so it's easier to see on an Excel spreadsheet. Okay, so you're going to implement this on an Excel spreadsheet. Any questions? Yes. There'll be instructions in the problem sheet. There's a screen. Very simple. You have Bloomberg downstairs, right? You can. There's an Excel. There's the Excel plugin on the. Really? I guess it depends on the subscription. Has anyone tried to? Have you tried to download CDS here? Okay, that's good to know. Yeah, that might be more boring then. Well, I will give you CDS spreads. That's annoying. No, that would have been fun. All right, okay. So how do you get, what have you been doing? Downloading it and just typing it out? Okay, yeah, but for a single date, it's only a few numbers, right?
Yeah, so every screen is 6 bits.
Yeah.
So
And if there's 5 years of data, that's quite a lot of numbers. Okay, I figured something out. But in general, you're going to do this as an exercise. For anyone that wants to do their own, you can get it somehow. You can do it. Otherwise, I'll give you the data. Make data. Okay, but in general, does this iterative process make sense? Okay, it's a super common thing, and there's millions of instructions out there, but again, it simply is that it's the equivalent of bootstrapping a default-free term structure. So the same process exists in the default-free term structure, where we sequentially back out the discount rates from default-free yields. We're going to assume that we know the default-free term structure here when we do this. All right, so that's what a CDS is. So CDS are equivalent, so buying CDS is equivalent to shorting a bond. Observing CDS term structures in the market under some assumptions allows you to back out default probabilities. However, in practice, there are differences between bonds and CDS because there are frictions in the market. So earlier I argued that at initiation, no arbitrage must mean that buying a CDS is like selling a floating rate bond and investing in a default-free bond. So that buying CDS is equivalent to shorting a bond. Or selling CDS is like taking a leverage position in a floating rate note. In practice, there are differences. So this paper is sort of a canonical example of that argues for differences between credit default swap spreads and corporate bond markets. So in practice, why are there differences? Well, frictions. So what are the frictions? In practice, that a CDS contract is not written on a single reference entity, but written on a basket of reference entities. So for a particular company, you will have a range of maturities for which you can deliver the bond. And so this tends to increase the CDS premium because it reduces the cost of delivery by the seller. In practice, there are costs to shorting bonds, and this also affects the CDS premium. And this generates something called a CDS bond basis. The CDS bond basis is the difference between the corporate bond yield and the equivalent CDS on that reference entity. So, for example, it changes, it varies a lot, and it varies in crisis periods. So here I'm showing you an example of what the CDS bond basis looks like, and it's an example of fiat. So this is the difference between a corporate bond issued by fiat and a CDS written on that bond. So you can see here that the difference is actually quite large at points in time, and it's generally positive. So the CDS bond basis is a positive number, being that the CDS premium is usually larger than the equivalent corporate bond. Here's another example. So France Telecom. France Telecom CDS premia change quite a lot over time, so this is like the difference can be as large as 250 basis points. So CDS premia, so the caveat to the arguments today is that the CDS bond basis, measuring the difference between corporate bond yields and CDS, is non-zero, and so buying a CDS is not exactly equivalent to shorting a bond. So there's some nice examples here of how the CDS bond basis looks like during the financial crisis. It's a friction-driven based thing. Here is the CDS bond basis for a group of investment-grade firms. So here in the blue dotted line, I'm plotting you the IOS LIBOR spread, which is the difference between collateralized and uncollateralized borrowing in the interbank market. That number is typically negative. Okay, LIBOR being higher than the IOS spread because it's uncollateralized. It's risky. At the same time, I'm putting you the CDS bond basis for investment grade firms. The CDS bond basis is negative as well. Here, I'm showing you the same plot, but for high yield firms. So you see that going from here to here, one of the factors determining the difference between, one of the factors determining the CDS bond basis is the creditworthiness of the company. Okay? So this is an enormous number in the financial crisis, and Colin Dufresne and Jenny Fry argue this is largely due to frictions. what is this? Why is the CDS bond basis so large? Well, one of the reasons here is that owning a CDS is not selling a CDS or buying a CDS is not exactly like shorting a bond because you have counterparty risk. Counterparty risk is the credit risk that your counterparty simply reneges on their deal. Okay, so CDS is OTC, so there's nothing to really enforce the bank, nothing to enforce the seller of protection to honour their agreement on default. In order to compensate investors for that, the premium charged for CDS is typically lower than the corporate bond yield. And it increases in the credit this is an increase in spread in the credit worthiness of the underlying firm, precisely because there is additional counterparty risk to that. Okay, so yeah, so essentially the margin requirements are like there's no margin requirements on CDS because they're OTC, and these leverage constraints and this counterparty risk are probably the main drivers of the CDS bond basis. Other arguments are that are for the margin requirements on the CDS position. So we talked a little bit about how one would mitigate credit risk. So we don't have any slides on this, but there's a new push towards at the same time the Big Bang, the standardization process of CDS was also the push towards central counter clearing parties. So now CDS is traded in something like the difference between a standardized electronically traded process and a OTC process. This introduced a bunch of additional costs, and I think this is why you see in 2009 the Big Bang is why you see such a large spike in the CDS bond basis at this point in time. All right, so I'm going to have to figure out something to do with the Bloomberg thing, but other than that, I'm going to post the first part of the coursework 2 towards the end of the week, and the due date is the Sunday before the very last class. So it's going to cover CDS pricing and CDO pricing, which we are going to do in 2 weeks' time. So next week is a free week. So the idea for the next week is that you're going to start the coursework and also use the week to revise the course. So I'm also going to post you these revision questions which cover the first 6 lectures of the course. Okay, so there's no class next week, right? Okay, thank you. Yeah.
Still not clear if we look at that expectation.
No, there's actually, it's actually correct. It's just that I've missed out a step here. So that what it is you take this expectation, 0 and tau. That's the expected discounted value of this one between R, S, and the S. So I'll post the additional step. It's basically 2 more lines in this derivation. So combine these two default processes. Remember we said that you can compute that expectation there by adjusting the short rate with a lambda. Okay. That then is equal to the expected value of so that is the expected value of this one. You can rewrite this and the expected value between 0 and t of E x B of that of e to the RS between 0 and tau multiplied by the integral. No.
That's basically what I'm wondering. Where does the small t come from? What is it?
Because it's the integral, because it's the product of this thing over the integral. So there's. Yeah, so actually we have it in the previous lectures, but I just missed the slides out. I forgot to include them on.
If you say that in the previous lectures, I'm just going to have another look at it.
Yeah, let me show you where it is though. So do you remember in the intensity module lecture, there was this trick where we did the conditional thing. So that was 5, right?
Yep.
Remember this? So what's the expected value of this one? I argued that this was, well, this is how to compute the expected value. Is this the same as this? So,
Because okay, then I believe I know where my confusion comes from. Because here we start at small t.
yeah, and t,
And
it's t minus, tau is t minus t.
Okay, because I believe that because we start here at 0, we assume.
Yes, if you do 0 to, if you do 0 to tau, it's like doing the integral between t.
Because that was this little t just didn't make any sense to me, but basically we are at little t.
Yeah, you're at little t, that's why I was saying that you could rewrite this between 0 and tau, this between t and t.
Okay. Basically,
And then you can compute the
we have
expectation.
tau and little t, that's just a mix-up of notation, but apart from that.
Yeah, it's notation.
Then my confusion is
Yes, I
gone.
probably should have used the two
Okay.
most consistent.
One. Thank you.
What is CDS one basis one?
So the CDS, the credit default swap spread, right? We denoted it C, maturity dependent. I said it was equivalent to a corporate bond yield. Called it what? Let's call that Y of the same maturity. So under no arbitrage in a frictionless world, this should be equal to each other. The CDS bond basis, it's called the CDS basis, is equal to the CDS that you get in the market, quoted by JP Morgan, minus the equivalent corporate bond yield. That is typically negative.
But if
So the meaning
there's
that
no
this-
arbitrage, this should be equal. That should
If there's
be.
no frictions in it, yes, under no arbitrage, if there's no frictions, they should be the same.
So
This is typically below this.
that's in the real world. It's people
In the real world, yeah. In the real world, they typically they will trade below them.
But did you say that the CDS spread is larger than?
Now the CDS bond basis is negative.
If the market is fractionless, we expect it to be zero, right?
Yes, yeah. Yeah, if the market is frictionless, it's 0. That's why the CDS bond basis is a measure of like the frictions in the market.
Oh, okay.
But why when there is friction? This one should be smaller than this one. Why is
Because there is the reason is if from one reason, for example, would be that there's two main reasons. Firstly, the corporate bond market is very illiquid. If it's illiquid, you typically demand like a higher compensation for it, so the corporate bond yield would be higher. When it's more illiquid, it gets even higher. The second reason could be that when I buy a CDS, if I'm trying to insure myself by buying a CDS from you, I face the you're the seller. You sold me a CDS. I face the problem that you might actually default on me. So bond defaults, and I come to you to say, hey, pay out on your CDS contract, and you just renege on your contract.
you mean the counterparty?
There's counterparty risk.
So you don't want to pay that?
So So I don't want to pay it, so I don't want to pay as much, so what do? I reduce the payment. Yeah, so in a fair world, I would pay this equal to this, but because I know that there's counterparty risk, I actually, the fair value I'm willing to pay is actually going to be below this.
But actually, here's also what we're discussing on
Yeah, the
default
bond,
free bond.
well, the default free bond yield includes the default probability anyway. Think about the Merton model. What do I, how do I value the corporate debt? Equal to a short put on the value of the assets of the firm. That depends on the volatility, the characteristics of the firm, right? So in a frictionless world, forgetting about CDS, Y includes the probability of default. Y minus R is the credit default spread. Right, so this should be equal to CDS, yeah. In practice, they're different. This would be already including default risk. This also actually includes some counterparty risk. Counterparty risk lowers the premium because, well, I don't want to pay you as much as the fair spread because you might renege on your contract. Secondly, in reality, these Ys are much larger than they should be because, you know, the corporate bond market is very illiquid. So these two driving forces which drive this spread. So, yeah, that's essentially the main drivers of it. I mean, so the only issue here
Capital
is,
T,
yeah,
right?
the only issue is that it's just the differences between T and big T,
Yes.
which is
Yes. Tau is default tau.
so here the reason why I skipped a couple of steps, but we actually have this derivation in a previous lecture. It's so when we did the intensity model lecture, I said, okay, so let's think about what this expected value of 1 is. It's this animal here, right? We said, hey, what's the probability of no defaults
Yes. Yes.
at t greater than t? What's the survival probability?
Yeah.
So this is the expected value of this one. I argued it was this
Yeah.
thing, right?
Yeah.
So then I said, okay, so let's take that idea and then let's do this by saying, okay, take the 1, put in iterated expectations, and here we're computing it between t and t.
Yeah.
So the only difference between this and this is just notation. That when we did it here, this is essentially the same as this, right? So up until this point, so here, so if you get to this point here,
I just thought there
Then you
might
just
be
split up.
another integral outside all of it.
Yes.
From 0 to
Yeah,
capital T, right?
there is, and that's how you get from this step to this step. There's another integral that goes all the way outside it.
There's no integral outside all of these.
So look at this. This is that integral there. There's one integral here, right? So we had two integrals.
Yes.
Now we have one.
Yeah.
But this is the expected value of e to the something. If you, it's like I can split this thing up just by making the independent assumption.
But the expectation of with the thing within this bracket, this whole thing is this P0T, right?
The expectation of this multiplied by this expectation is the integral of the product of this and this.
Where is this come?
This lambda here is the derivative of this thing. Yeah.
So the first term and the third term are this
You're
part.
integrating. There's an integral here, right? There is a second integral within this S. So these two integrals there are two integrals here, but you're only seeing one of them outside the product of everything.
So is this, there should be capital T? The tau here.
Yeah, so the tau is the T, yeah.
And where is this?
The 1 minus gamma should be outside here.
Yeah, so
Yeah.
I will need to add that one.
But there is still two integrals here, right? Because this is between, at each point in time, At each point in time, so if you were to compute this integral, you would do the following. You would integrate, this is going to be a function,
Yeah.
which is simply the expectation of this integral. So this is just think about this as being, this is the expectation of an integral. This is a function. So it's e to a function, which depends on t. Right? It's at each point in time t.
Yeah.
Then you have a second integral.
Yeah.
Okay, so this is a function multiplied by another function multiplied by another function,
Yes.
which are all a function of t.
Right.
And then you integrate this function between 0 and capital T.
Yeah. What I mean is that we need to add an integral with a bracket of all this because we need to integral from 0 to t. But actually, I think we need to add
Where's
a
the
0 to t.
exponential?
Which exponential?
Because if you put all the integral,
These are exponential functions.
yes,
So this, for example, this is an exponential function. That is that function there. That's an exponential function. It's a discount factor.
Yep.
That's also going to be an exponential function. It turns out to be an exponential function.
so you put the integral inside.
The integral is over all of the exponential, the product of the exponentials. But at each point in time, one of those, there's another integral within that.
Oh, okay, so it's over each time t, small t.
You
there's a
integrate
big
up to t, and then there's a big T
big
that you
T
integrate
integral
over again.
outside.
But this line, this is just about the small t at that. But then we take integral of this.
Yes, because this is so okay. So that's why I'm saying take this same derivation is here. It's just notation because here we have it between t and here we have it between t and big T. Here we just have it up until tau, which is like saying, which is just like this. So here it's the difference is just between 0 and tau. It's the same as doing it between t and big T. Because tau is the default time between today and capital T.
Yep.
So that's just notation from going from here to here. So here I could have started with T and big T, but I still would have had a tau here, right? It just depends on where your perspective is, right? So where is today? Is today 0 or is today T?
Yeah, okay. Got it. Thank
So that's what it is. But then the important point is that this is messy because it has two integrals here that you're computing at each point in time,
Yeah.
and then you do that over all capital T.
Yeah.
So that's the integral that's,
Integrals are integrals.
it's an integral of an integral. It's a double integral, yeah.
Yeah.
Which is why I said here, this is, we want to get rid of this integral. It's nasty,
So
right?
we only have one.
Yes, we actually get, so we want to get rid of one of the integrals, so we made this assumption. And this assumption,
Pairwise constant so that we can
we made the assumption here that we got rid of one of the integral was just that the default would always happen at the same point in time. So I don't now have an integral over all of the time period. I just know it's a summation. It's not continuous, right? Exactly. We live now in a discrete world where you definitely default in the middle of the interval. That therefore simplified it to this. Now, this is the exponential function. Difference between two exponential functions, and this is just a summation. But that thing looks actually like this thing. Imagine if you just had two different values here. So that's how the trick works basically.
Oh, and right this one. So where's the 1 over C?
1 over
8, so C 0. And there's another plus.
the very first payment here.
Yeah. So why is it 0?
Well, because what's the, because we assume that the spread for zero is a zero spread, right? What is the spread for zero? It's just going to actually be, it just depends on the first Q. So each point in time, I only depend on two Qs if I know the first one,
Yeah.
when I compute this sum. So I can recursively do it.
So if I have this is 0.25, so
Yeah.
it's 0.25 over 2, which means 0. Between.
Wow, no, it depends on the, so let's say they have them quoted at quarterly intervals.
Yeah.
I mean, then, no, so in reality let's imagine that they're quoted in yearly, just
Yeah.
for sake, right? So the first one is going to be the CDS spread for 1 year.
Yep.
The second one will be the CDS spread for 2 year.
Yep.
So it depends on the Q between default happening between today and 1 year,
Yep.
and default happening between 1 year and 2 year. Imagine I had the CDS spread for 1 year.
Mm-hmm.
That only depends on the default between today and 1 year.
Okay.
So it depends on the first Q.
Yep.
The second CDS spread depends on the default probability between today and 1 year, and 1 year and 2 year.
Okay.
So the 2 year CDS depends on two lambdas,
2 lambda. Yep, 2 lambda because it's the.
and the first one only depends on 1 lambda. The third one depends on 3 lambdas,
lambdas.
but I can recursively back them out because
Yeah.
I can get the first one. From the first one, I can
Okay,
solve for
the
the second
second
one,
one,
and the second one I can
and
solve for the
third
third
one.
one.
Yeah, but then why is it 0? I'm just curious. Why is it 0 on the second term?
Which one do you mean?
Yeah, because in here you say it's 0.
It's just for the very first one.
Yeah. So why?
So in the very first one, think about what the present value. Think about what the cash flows are in the first one. The cash flows in the first one is just what do? We do buyer equals seller.
Yep.
I'm going to make a coupon payment to you. What's the present value of that coupon payment? Well, it's quoted as C over 4. And then it's going to be times the probability, the P. We assume it happens in the middle of the year, so it's going to be, let's call it T over 2.
T2.
Well, yeah. No, for this one it's TI, right? It's 0T, and times the probability. So what's the expected probability that I make that payment? It's Q.
So it's tau greater than T.
Yeah.
Okay.
That's the protection. That's the present value of the protection seller's leg. That's the probability that I make the payment times the discounted value.
Okay.
What's the value of the recovery of the seller's leg? He's going to pay me 1 minus delta times the probability that default happens.
Oh, okay. It's
The default happens at the midpoint in the interval, which depends on the default happens in the midpoint. So that's why I have these two values here.
yeah.
Actually, basically compute the present value of the cash flows for at the first payment only depends on 1 Q.
But on the starting from second payment, it will depends on the
Second Q.
second.
Depending on how they're spaced out, they will always just depend on the very next one. And so you can recursively back them out.
All right.
So are we sure you cannot download CDS data here?
No, actually we can, but like not on the business school site.
So where do you get it from?
From the library, second floor.
So you can get it.
Yeah, but the thing is, that depends on the computer because there's only 1 or 2 computer in the library in second floor where I can get the CDS.
Okay.
But then I'm not sure about the others. On the business school site, there's no way.
That's annoying.
Yeah. Because I try to look for it for my project.
Yeah, I was going to say, because aren't some of you doing CDS projects for your applied research thing?
No, I do a research for my own,
Okay.
so I need it.
Okay.
Oh, can I ask also about a question from the lecture 5?
Yep.
Because I was a bit confused about the theta thing.
Yep.
It's really neat about this thing. So in here we have this function,
Mm-hmm.
but then here we'll have this. I don't get it because this makes sense if this is smaller than 0, but this does not make sense to me unless this is greater than 0.
It's a negative number, right? Sorry, it's a number greater than 1. It's a number greater than 0, yeah.
It should be, right? But then in this one you say it's negative.
Oh, sorry, no, it must be a negative number, right? Yeah. So this is because it is a negative number because then it makes the ratio, this ratio
yeah,
positive.